Hello guys, and welcome back to another video on this channel. So Zoom has reported earnings and the price has been skyrocketing since then. So this stock needs no introduction. They have become a household name during the pandemic, soaring 10x from their IPO in 2019, only to fall 82% since the top because of the reopening. So the question is, has the price become attractive enough, and is Zoom a buy now after this earnings call? I'm going to do a fast analysis on this company. And if you want to get access to the table that I'm going to show here, you can visit the first link in the description box below. It's a link to our Patreon. You can get access to it for $5 a month, and to all tables that I use to evaluate all the companies that I cover. And you get access to articles and Patreon's only data and my eternal gratitude. So Zoom has a problem, and the problem is kind of itself. And what has happened to it is that it has been growing like crazy. You can see in 2017, they grew 149%, and then next year, 118%, then 88%, then 325%. This is epic. I don't know if I've ever seen any company in this size do such growth, right? Then in 2021, they did okay, but the problem is that all this growth has gone away. They reported earnings. They're guiding for 10% growth, and nobody knows if they're going to start growing. Obviously, we're in a once in a 10-year opportunity to buy great companies, and your job as an investor is to find great companies at great prices. So Zoom is a great company. They have almost $6 billion in the bank in cash with no debt. They are highly profitable. There's zero chance of them going bankrupt. So they're a great company, but are they at a great price? So this is what we're trying to establish here, right? So the problem with the growth disappearing is that the growth investors are gone from the stock. They're out chasing other stocks, like my Palantir, my favorite stock. So there's value investors left. But the question is, has the price fallen enough for value investors to step in? So let's see how and what they reported. So I'm just going to give you can see that the revenue was up 12%. They had a GAAP operating margin of 17% and a non-GAAP operating margin of 37.2%. This is when you add back basically the stock-based compensations for the employees. Based on their free cash flow, they have a 49% cash flow. Nuts. Really great numbers. Again, here, what you want to look for is their guidance for the full fiscal year. And you're going to see that, you see 5.7 billion in cash, fantastic cash flow. So here you can see their full year guidance, and they're guiding for about a 10% growth. I listened to their conference call, and they are saying they're working on a lot of products to increase the growth, but it's nothing that they're guiding for, is nothing that can be calculated, it's nothing that you can think with. I normally like to do a thesis, because whenever you do a valuation on the company, it has more to do with the future, and obviously what you think about the company matters a lot, because you can come up to any price, and the only way to make sense of it, if they're going to grow into that story or contract into that story. So I just want to tell you what I think about Zoom. I think they're going to continue to grow 10%. I think that their operating margins is going to be very stable at around this 26%. Obviously, if it comes up data that their operating margin is 30 something, it greatly changes the price. But what really changes the price if they can re-accelerate the growth. And I actually put it here as a major upside. However, I want to really stress that currently there's nothing that says, other than that they're trying to do it, but nothing tangible from an investor viewpoint that says that their growth would re-accelerate. And then I added a little bit of upside because, everybody's worried about inflation and employee costs, and Zoom is actually very deflationary, meaning that you can save a lot of money on both employees and costs around employees. I have a Swedish real estate development company. We are building hundreds of apartments. We use Zoom and Teams a lot. It's mostly Teams. And we save unbelievable amount of time with not having to meet with engineers. And the engineers can be in different Swedish cities. And, we can still have meetings with the architect and plan out the apartments. It's fantastic. And another really big upside is, if for many companies, if US employees becomes too expensive for many positions like accounting, architects, renderings, tons of stuff. You can hire people from overseas and again, keep in contact with them with Zoom. And this is a very good way how you can, protect your company from rising employee costs. I believe that this is a potential upside for them. Now, what is the risks on Zoom story? The ones that I could identify was that, there is a fear that people are going to abandon them with the reopening. However, I don't see this happening. What I see is that if you didn't get Zoom during the pandemic, I don't see why you would sign up for it now. But if you have Zoom, because in Sweden, life is basically 100% back to normal. And we have a lot of physical meetings now, but we still have Zoom meetings and we still have Teams meetings. And it basically is here to stay. It's never going to go away. And the monthly cost of Zoom is so cheap that I don't see, if you got it during the pandemic, I don't see why you would cancel it. Then they have a ton of competition. Microsoft Teams is a very tough competition. We actually, because in my real estate development company, we have MacBooks, what we work with. So we actually really prefer Zoom, but all the architects, engineers that we work with, they all want to use Teams. It's a really tough competition for Zoom. And the thing is that Microsoft Teams is included in the Microsoft Office package, so it's technically for free. And I can completely buy this argument that if you're already paying for, the Microsoft Office and they for free include Teams, then why would you pay for an extra service like Zoom? So I think they have a bit of a tough time here. So now let's go to the very, very important thing, which is my valuation method, which is based on a very simple method of predicting what the stock price is going to be based on the earnings of the company and the PE in given years. I think that if a company is growing, let's say 10%, I think that between a PEG ratio of, 1 to 2, I'm very happy with the company valuation. That means that if they're growing 10%, they can have a PE of 20 and the PEG ratio would be 2. And I think that this is a fair valuation. If the Fed is very, very hawkish, then, maybe 1.5, maybe 1 is a good valuation. But obviously 3 and 4 and 5 would be way too much. Remember that they're down 80% and currently their price to sales is 7.32. Still, it's not dirt cheap. It's not expensive. It's somehow in the middle. 5 would be quite cheap. 10 is a bit expensive. It's right there on the middle. Their PEG ratio, if they're growing 10, because they're at a P of 28.22. So compared to their projected growth, which is 10%, their PEG is 2.82. And that's quite expensive. As I said, I want this number to be, at least 30% lower, below 2. Then I would be happy with this number. So in this table, I added in how much I think that they're going to grow and what that means for their revenue. If they have the operating margin at 26%, then this is the operating income. I even counted with the fact that they're doing stock buybacks, which actually results in a negative dilution in the stock, which means that, you will have less stocks to divide this profit on. And if nothing changes, so if they keep the 10% growth, the 26% operating margin, they're going to have, and the P is, if they're growing 10%, a PEG of 2 would mean a P of 20, and the P of 20 based on these earnings would give them a market cap of $31 billion. Based on the amount of shares, that would be a share price of $106. Currently, the stock today is trading at $100.51. So that is really not a good deal, despite the stock being down 82%. And that is because, again, the stock is not a growth stock anymore. So the growth investors don't want anything to do with it, but it's not low enough for the value investors yet. I normally like to have 30% return per year, and this is how I invest. And I like to have investments where, you can buy a stock and not think about it for the next 5 years and be basically sure that the money is going to be invested in a very good place. Palantir is such a stock. Tesla is such a stock. Tesla valuation is insanely good. Palantir is also insanely good, but Tesla is better currently in the last few days. So if I would want to have my return, I would need to have a $37 stock price today for this stock to be sexy. So obviously for me, this is not a buy, but just for the purpose of the video, I want to see when there is, when the value investors would step into this stock. So I think if you're a value investor, you would be happy with the 10% growth per year. We can debate in the comments. Let's say that we would be even more pessimistic on the PE. Let's say that you would want a lower PE for you to feel safer. Yeah. Then it's crazy. Okay, I leave the P. Let's say that you're okay with the 20 P. So if you want to have 10% return per year, the stock would have to go down to $73. So around the $73 mark is, I think, when the value investors are going to come in and scoop up the stock. The stock market has been crazy, so we don't know. Maybe it can go down to, I don't know, $50 even. I don't know. But around $70, this stock is becoming a great buy if you're a value investor. This stock, because it's not a growth stock anymore, is not really my investment style. I'm very much focusing on Tesla and Palantir, and I'm really happy that the prices are falling because it means that I can average in and build out a bigger position at a fantastic price. However, if the growth re-accelerates in this company, it's really worth another look. For now, I'm not touching it. Please let me know what you think in the comments. Again, if you want access to this table, check out the first comment in the description box below. You can get access to this table and all the other tables for all the companies that I cover. See you in the next video.